What is going on, ladies and gentlemen? Today we're going to be talking to you about another one of the option Greeks, and that option Greek is gamma. Now, gamma is a little more difficult than delta and theta, but really the basics of gamma is that it is the price that the delta changes when a stock moves up or down. So if you have a call and your stock moves up, your delta is the price your options contract changes every time that stock goes up $1, but your gamma changes the price of the delta every single time your stock goes up $1. So the gamma is the price change of the delta, and the delta is the price change of the actual option. So don't try to overcomplicate that. It's really nothing more simple than that. Of course, time and volatility have an effect on this as well, but you can go read more about gamma if you want to understand its full potential, but this is just the basics of gamma. So let's go into a stock that has $1 increments in between the strike prices and look at how gamma works. Let's open up this 105 contract and this 103 contract. So as you can see on the 105 contract, the gamma is 0.1219 and the delta is 0.1287. So that means if Nike moves up $1 closer to 105 or down $1 away from 105, it's going to change the delta price by 0.12. And that makes sense because if Nike went $1 away from the 105, this contract would be worthless. It would be worth 1 cent because the delta is greater than how much the contract is even worth. But the delta after that move, because of the gamma, would be like 0.001. So in order to get this gamma and the delta back up, the stock would have to start moving even more than it was before because the gamma was pricing in more for the stock to go up, and so was the delta, and that's just getting a little too complicated there. So just know that the gamma changes the delta, because if we go to this 104, you can see this contract is worth 0.28, so add these together, 0.1287, 0.1219, that's about 0.25. That's pretty close to 0.28. So this 104 contract's gamma before Nike was at 103. When Nike was at 102, the 104's gamma and delta was a lot lower. I bet the gamma was like 14, and I'm sure the delta was maybe like 15 or something like that. Well, pretty close to there. That's not accurate because of their points. But as you get closer to at the money, which is this 103, it's literally at the money. Your gamma is the most it'll ever be. So when we go to this 102, you can see the gamma starts decreasing as we get further in the money. So at the money is the most volatile time for the delta to change prices. And how does this benefit us? Well, when we're picking a contract, we can kind of assume how much the contract is going to start moving if it starts going in our favor, or how much the premium's going to lose if it stops going in our favor. So if we bought an at-the-money contract, we know that if it goes in our favor, we're going to start making more money faster, but if it goes out of our favor, we're going to start losing money faster. So you always want to check the gamma when you're looking at these contracts. If that's part of your strategy, looking and finding options contracts that are pricing in wrong. But really, if you were going to ball out, you might as well just buy deeper in the money than at the money, or just go cheap and buy farther out the money contracts. Option trading is extremely risky. You lose most or all your financial investment. Please consult with a financial advisor. Not a recommendation. Educational purposes only. Thank you. So always remember that you need to learn about these things before you just go and purchase whatever you want. But that's really the basics of gamma. And if you were going to try to price in how much the gamma would change the delta, say we want to know how much this 103 contract would be worth if the Nike call went up to 105. The 105 would be a $2 move, so you could do 2 times the gamma, which is 2 times 0.233. That would be 0.466, and then you would add 0.466 to the delta, and that would be 0.9726. And we can even kind of verify that because we can go $2 away from 103, and boom, 0.86. It's not exactly accurate, but that's pretty close to what we assume. And that's just an estimate because this gamma is going to change once Nike moves $1 to 104. This 103 contract's going to be in the money, and the gamma's going to go down, but the delta's going to go up. So that would just be a simple calculation to estimate how much you think the delta is going to be, depending how much the stock actually moves in your favor or away from your favor. So you always got to remember that. The closer it gets to at the money, the more gamma it's going to have, and then the farther it goes out the money or in the money, the less gamma it's going to have. You just got to understand how the delta works, and then you can factor in the gamma pretty easily. So let's do it on the put side so you guys have one more visual representation. So on the put side, the 103 is the at the money contract. It has a gamma of 0.2350. We go to the 104, it only has a gamma of 0.2. The 102 has a gamma of 0.187, so that's how you can always tell which one's your at the money contract. If the stock went down to 102, then this contract would go up what the delta is. So if Nike went down to 102, the 103 contract, if we bought it, it would go up in this price, the 0.4934, but then the gamma would change the delta. So then it would be at about 0.72, and the gamma would decrease. And of course there's other things that go into that, volatility, the time, but that's just the basics of it. Every time the option price moves, it's because of the delta. Every time the delta moves, it's because of the gamma, and they all move in sync. So when the option price moves, the delta and the gamma move at the same time with it, and vice versa. So you always want to be sure to look at these, because then you kind of know how much your contract's going to increase or decrease as the stock goes up and down. And it works both ways on the put side, but like I said, if you want to get more complicated with it, you can. I'm just trying to make it very simple and basic for you guys. So I hope you guys enjoyed this video. If you have any questions, leave them in the comments below. Be sure to leave a like on the video. Be sure to subscribe to the channel, and check us out live. We're live Monday through Friday, market open to market close, and we'll see you guys in the next video.